If you're a first responder or a city worker or any W-2 employee that makes decent money, you're probably paying a lot in taxes. Here in Massachusetts, if you're making $100K a year as a W-2 employee, you might be paying upwards of $30,000 a year just in taxes. The good thing about this is that you can actually offset that amount that you pay in taxes through real estate. And today I'm going to show you how. See, let's say you buy a home and you rent it out, you use it as a rental property. So that property, just like this calculator, just like this stapler, has a lifespan in the eyes of the IRS. So for the calculator, it might be a year. For the stapler, it might be 5 years. But for that house, since it's a residential home, it will be 27 and a half years in the eyes of the IRS. So what that means is that you could take a deduction for what the IRS expects to depreciate from that home over the course of 27 and a half years. But the good thing is, through something called a cost segregation study, you can actually take that depreciation even quicker than that. You can't just deduct your losses from your rental properties and cut them off from your W-2, right? Because the federal government, the IRS, has drawn a line in the sand between the two, where they consider your rental properties, that type of real estate, they consider it passive income, and your W-2 is active. So you really cannot cross the line between these two, except for a couple of exceptions. First one is that if you work in real estate on the side, and